I'm going to walk you through this the way I would if I were sitting down with my Iraqi dinar news audience and breaking it all down fresh, because what's happening right now in gold, silver, and the broader monetary system is not normal, and it's not something you can really understand if you look at it through old frameworks. For decades, the precious metals markets were dominated by paper trading. Physical delivery was almost an afterthought. Historically, less than 1% of contracts ever resulted in someone actually demanding metal. Most players rolled positions, settled in cash, and moved on. That system worked as long as confidence held and as long as paper claims vastly outnumbered the people willing to call the bluff. What has changed, and this is the key point, is delivery. We are now seeing month after month of record physical deliveries, and this has been going on for well over a year. This isn't a one-off anomaly, it's a trend, and trends like this don't happen by accident. When you overwhelm a paper-based suppression system with physical demand, price behavior changes. That's exactly what we're watching unfold. Gold and silver are beginning to reflect something closer to real price discovery, something they've effectively been denied for generations. If you go all the way back to the era of coordinated interventions in London, you can trace a long history of managed prices. Physical delivery at this scale breaks that control mechanism. There's no elegant way around it. When enough people say, "No cash, I want the metal," the paper game starts to crack. You'll hear some voices calling this a bubble, and I understand why that word gets thrown around. Markets have moved fast, and whenever prices rise sharply, caution is always warranted in the short term. But calling this a bubble misunderstands the nature of what's happening. This isn't a technical rally driven by momentum traders chasing charts. This isn't retail euphoria. This is a loss of trust playing out in real time. Trust in the dollar, trust in institutions, trust in the system itself. Gold and silver are responding to that erosion of confidence, and they're doing it through physical demand, not hype. The most important detail that gets missed is who is actually taking delivery. This is not the general public. Most people couldn't tell you the difference between an ounce and a kilo, let alone navigate a delivery process. The buyers here are sophisticated, well-capitalized, and extremely informed. When those players stand for delivery at unprecedented levels, that's not speculative froth. That's positioning. Price targets get people emotional, so I want to handle this carefully. You'll hear numbers thrown around that sound outrageous by today's standards. But those numbers only seem crazy if you assume the system we're in now remains intact. If the dollar's reserve status weakens or collapses, the math changes entirely. Gold isn't just another asset in that scenario, it becomes the reference point. Imagine debt instruments tied to gold at today's prices, and then fast forward 20 years into a radically devalued currency environment. What looks expensive now becomes cheap in hindsight. That's how entire industrial transformations can be financed without crushing borrowing costs. It's also how other countries have competed against the United States for decades by exporting goods into a stronger dollar while weakening their own currencies. This is where Triffin's dilemma comes into play. A reserve currency issuer must supply the world with liquidity, which inevitably leads to trade imbalances. The dollar's strength has been both a privilege and a curse. It hollowed out domestic manufacturing and locked the U.S. into structural deficits that can't be fixed with policy tweaks. If you want to bring manufacturing back in a meaningful way, you can't do it with an eternally strong currency. Something has to give. What we're really talking about here is the early phase of a new monetary architecture. In that system, gold doesn't just sit in vaults as a relic. It functions as a settlement asset, a credibility anchor. Old school technical analysis struggles in environments like this because it assumes continuity. We're not in continuity anymore, we're in transition. Silver adds another layer to this story. The US government has quietly acknowledged silver as a critical mineral. That alone should make people stop and think. A price floor backed by state policy isn't about speculation, it's about supply security. Most easily accessible silver deposits were mined long ago. What remains is deeper, more expensive, and often recovered as a byproduct of other metals. That means higher production costs. If you want domestic supply, you need prices that justify the investment. Strategic stockpiles, incentives for mining, and price support mechanisms all point in the same direction. At the same time, the broader economic backdrop is deteriorating. The country is drowning in obligations when you account for entitlements and long-term commitments. Productivity is weak. Manufacturing capacity is thin. Education outcomes are alarming. Into that environment steps artificial intelligence, which is rapidly displacing both entry-level and white-collar jobs. Tasks that once justified entire career paths can now be done instantly by machines. This is not a future problem. It's already happening. If the U.S. remains dependent on global supply chains for everything from basic pharmaceuticals to aerospace components, it becomes strategically vulnerable. Reshoring isn't a political slogan. It's a survival requirement. But reshoring at scale is impossible without addressing the currency problem. That brings us back to gold, and to a lesser extent silver, not as speculative plays, but as tools in a systemic reset. One of the most striking data points is the sheer volume of silver being delivered. Tens of millions of ounces moving month after month. This is not coin collectors stacking in their basements. This is industrial scale accumulation. Add to that the imbalance between outstanding paper claims and available physical metal, especially in major trading hubs, and you start to see how fragile the system really is. If even a fraction of claim holders demanded delivery simultaneously, the mismatch would become impossible to ignore. Market mechanics are adding fuel to the fire. Margin requirements have skyrocketed in a very short period of time. For leveraged traders, this is brutal. Positions get liquidated not because the thesis is wrong, but because the cost of maintaining exposure explodes. Historically, margin hikes were an effective way to kill rallies. This time, they haven't worked the same way because the buyers who matter aren't using leverage. They're paying cash and taking metal. Margin hikes become irrelevant to someone who doesn't need margin. Even refiners are feeling the strain. Processing metal takes time, and hedging inventory in a rapidly rising price environment becomes extraordinarily expensive. When hedging itself threatens solvency, business grinds to a halt. That's not a healthy market, it's a stressed one. Zoom out further and look at relative performance. Equities had a strong year, especially in technology, yet precious metals have outperformed them by multiples. This isn't supposed to happen if metals are dead money. The traditional portfolio models people were taught to trust are breaking down. Even at the highest levels of institutional finance, that reality is starting to be acknowledged, although it hasn't filtered down to everyday investors yet. What we're really seeing is not just anti-dollar positioning, but skepticism toward the entire credit-based system. Gold and silver represent final settlement. Everything else is a promise. In times of stability, promises are enough. In times of transition, they're not. Importantly, this is not a retail mania. The public hasn't piled in, fear hasn't arrived. That emotional blow-off phase people associate with bubbles is nowhere to be found. Positioning is happening quietly, methodically, and primarily at the top of the food chain. Outside the United States, major economies are building alternative settlement systems, digital currencies linked to physical commodities, cross-border payment networks that bypass legacy infrastructure, and a growing web of regional vaults all point to a multipolar monetary future. Local currencies circulate within trade blocs, while imbalances are settled in gold. That reduces dependence on any single reserve currency and spreads monetary sovereignty more evenly. If you ask me where prices could go, I'm cautious about making hard predictions. But I will say this, levels that once sounded extreme no longer do when you factor in the scale of systemic change underway. A slowdown at higher prices wouldn't surprise me, but neither would further upside that shocks people anchored to old assumptions. Silver, in particular, remains severely misunderstood given its industrial importance and supply constraints. The takeaway isn't that everyone should rush out and buy metals tomorrow. The takeaway is that the world is changing faster than most people realize. The signals are there if you're willing to look past conventional narratives, trust your judgment, question inherited frameworks. We're navigating uncharted waters, and in environments like this, intuition grounded in reality often beats models built for a world that no longer exists.